Ladies and gentlemen, Matthews here from M&A Forex Traders. I'm here with four most common biases that affect Forex traders and how you can learn from them and then become a consistently profitable trader. So for that and more, watch the rest of the video. So, so the first common bias that affect Forex traders and most traders are not even aware of is what we call the confirmation bias. So, this is the tendency to look for information that confirms our beliefs and ignore information that contradicts them. In Forex trading, this bias can lead us to seek out information, only the information that supports our position, while ignoring information that suggests that the market may be going against us. I'm sure you've encountered such a situation before, right? So this is very common where, for example, you are looking to trade Euro USD long, right? So you're expecting the dollar to be weak than the euro. Therefore, you want to what most people do is that they go and compare the DXY and try by all means to find that it's also going down. And when they confirm that, they'll try and look for news events, that news reports and all that may suggest that the market is going to go in a direction, right? They'll try to find ways to confirm their idea to actually go long Euro USD. And then in that quest, you may actually find some information that is telling you otherwise. But because you are so focused on trying to buy Euro USD, you're going to ignore all that, which may be bad at the end of the day. So, but if you are aware about what is the confirmation bias, you'll be able to stay calm and get the information that the market presents to you. Be neutral and not have a biased mindset, because if you have a biased mindset, most likely you are going to ignore the important information that would have saved you a lot of money. So it's important for us as traders to be aware of such biases so that we are able to make informed decisions when it comes to forex trading. So it's really important. So I thought I would share that. All right. So the next bias here is what we call the heading bias or the bandwagon bias. All right. So this is the tendency to look for the crowd, to follow the crowd and make decisions based on the actions of others rather than our own analysis. In trading, heading can lead to traders making decisions based on the actions of others or on the market sentiments other than following their own analysis. By doing this, you are going off emotions and following the head instead of following your positive edge, which you've proven for yourself. Therefore, you need to forget others and focus purely on your strategy, on your edge, because you have the data that shows that your strategy works. All right. Everything else is just noise. Unfortunately, this is very common right now because you're going to realize that most traders are actually in more than five Telegram communities. There are more than in five Facebook pages where they are receiving trading informations, trading signals, and all that. That just shows you that you're not confident in your strategy. Because if you're confident in your strategy, you are going to only be in your own group. If you have a you are being mentored by someone, you're only going to be in that particular group because you have the confidence in that strategy. All right, you won't find me in any groups out there because I trust my strategy. I trust our age. So it's really important for you to avoid taking trades based on the ideas from others and focus purely on your age. This is going to save you from a lot of losses. All right. So if you're new, find a strategy, learn from a mentor, master that strategy alone and prove to you for yourself that it also works, then you can just focus on that and ignore all that, because it's just going to cause you to lose money because you don't understand why the other person is taking the trade. So it's really, really sad. Unfortunately, this is what happens most of the time. Most people take trades based on people's uh, ideas instead of focusing on their own. This just shows lack of confidence in your strategy. So make sure that you work on your strategy so that you'll be able to take these trades as they come. All right. Remember, the importance of us talking about this is for you to be aware of these biases, which most of the times are just unconscious. We are not even aware of them. We're not aware of them. So by me talking about them, I'm bringing them to your consciousness. All right. So it's really, really important, and make sure that you are really paying attention. All right. So the third type of bias is what we call loss aversion bias. Unfortunately, this is very, very, very common. All right. So this is a tendency to feel the pain of losses more accurately than the pleasure of wins. This is the tendency to feel the pain of losses more acutely than the pleasure of gain. In forex trading, loss aversion can lead you to holding on to a position for too long, to a losing position for too long in hope that the market will turn around. Remember, each trade is just a single data point in a larger distribution. There will be losses and there will be wins. Don't avoid taking trades out of fear. You simply can't avoid them, so you have to learn how to embrace them as part of the process. Don't let losses put you into put doubt into your mind. Remember that the math will always play out in your favor. You have your positive. If you have a positive edge, you win more when you win than when you lose. Remember, you win more when you win than you lose. Assuming you have a positive edge in the market that has been back tested and forward tested and has proven to you that it has a positive expectancy over a series of trades. You don't have to avoid any losses. The law of large numbers is working in your favor. Focus on thinking probabilistically and not emotionally. So unfortunately, this is really, really sad, right? Because most of the times, when you take a losing trade, for example, it's going to carry much more negative emotions, such that even if you won the next trade, you don't feel as much, right? So don't focus on the losses. Learn from the losses and keep on moving. Losses are going to happen, and there's no way for us to avoid them completely. Like I always say, we have to embrace the losses. Just like Trader Tom says, the best loser wins. So there's no need for us to avoid losses. We have to embrace them because that's so much a significant part of trading. Loss aversion affects most traders out there. You have to overcome this so that you'll be able to trade properly and become a consistently profitable trader. Always remember, have a proven edge and keep on executing trade. Don't try to avoid a trade because of fear. Because the last trade was a loss doesn't mean that the next trade is going to be a loss, right? Like there's it's just randomness. You have to focus on a larger sample size. That's where the edge lies. The edge doesn't lie in you taking three, four, five trades, right? Because in that particular those particular numbers, it's just too small for the market for the probability to actually play out. So make sure that you are taking a larger sample size of trade and focusing on larger sample size. That's the only way you're going to remain consistently profitable trade. You have to be. That's the only way you're going to remain a consistently profitable trader, right? So let's go to the other one right here. So the other one here is what we call the recency bias. So recency bias is basically a psychological phenomenon where an individual gives greater importance to the recent event as compared to what happened before. This is very common. This is a very common cognitive bias. Forex traders tend to give more importance to the short-term performance as opposed to the long-term performance. For example, A traders who experience a previous win or a loss will expect the same to happen in the next trade. Common trader bias, but as you've learned, each trade is random and has no relation to the one before or after it. Anything can happen in the short term, and being aware of this is vital in your trading. Like I've already explained, there's a random distribution between wins and losses. And the fact that you've taken winning trades on the previous trade doesn't mean that the next trade is going to be a winning trade. The fact that you've taken a loss on the previous trade doesn't mean that the next trade is going to be a winning trade. Like there's no correlation whatsoever. You have to be able to have a long-term mindset where you are focusing on taking a larger sample size. Because if you have a strategy that has been proven to work over a series of trades, you are going to be a winner. In the meantime, you have to be comfortable taking losses. You have to be able to stomach those losses, because it's through taking those losses that we are coming closer and closer to a winning trade. That's how trading works. Think in terms of probabilities, have a larger sample size kind of mindset, and then you are going to be profitable. On a trade by trade basis, there's literally no way to know. So, for example, let me just show you some of our results for last week. This was last week results. We had a lot of losing trades last week, but if you look at this table right here, this is shared on a weekly basis. This is a trade summary of the trades that we take. You're going to realize that the first trade was a loss. Euro ZAR, USD ZAR was a loss. The next trade was USD JPY, which was also a loss. And then the third trade gave us 12R. Do you see how significant that is? All right. The next trade, AUD NZD, was a loss. Euro JPY was a loss. CAD JPY was a loss. Swiss JPY was a loss. And then we took an NZD USD trade, which gave us 20R. And then the next trade was a loss, which was an USO. As you can see from here, there's a random distribution between wins and losses in any given set of variables that define our age. We are predefining our ages, and we continue to execute our strategy regardless of what was happening on the previous trade, understanding that this is all probability. But the most interesting part is down here. If you look down here, there's net gain RR, and total pips right here. You can see that even though we lost more trades, we were able to still be in profit massively. Why? Because we have our setup which has a higher risk to reward ratio. All right, so it's never been about the win rate. It's all about having a strategy with a good risk to reward ratio. You can see here 20R, 12R, and our losses are just 1R, 1R, negative 1R. And when we win, we're making sure that we're winning big. And you can see that also we're kind of consistent. Our stop losses are there, and they're actually, we keep them small, and then our rewards are actually big, so that even if you lost more trades, you're still going to be profitable. But this here just shows you how you are supposed to be able to accept losses, because it's easier to give up after taking 4 losses in a row. But guess what? After taking 4 losses in a row, you get a trade that gives you 20R, and without you taking the next trade, you wouldn't have known that this was going to be a winner. I had no idea that this trade right here was going to be a winner. This NZD trade was going to be a winner. I had no idea. All I was doing was executing my proven edge and having the confidence that if I continue to do this, I'm going to be profitable. Unfortunately, most people are not equipped to handle trading like this. Most people are not equipped. That's the reason why over 95% of traders consistently lose money in the market, because they avoid losses. They don't embrace losing. In this game, if you want to be a consistently profitable trader, you have to embrace the losses. You have to accept the losses. one trick that you can actually do is that whenever you take a trade, before you take a trade, accept the risk in advance. Tell yourself, I'm accepting this loss on this particular trade, so that even if it happens, it won't affect you. Another trick that you can also implement is, before you take a trade, tell yourself that I I am wrong on this particular trade until proven otherwise. I am wrong until proven otherwise. So that when that trade goes against you, you won't be affected emotionally because you'd have already anticipated that loss. So this is really, really important. So if you like to trade the way we trade, like I've shown you in the previous videos and all that, if you'd like to have access to this kind of trading psychology videos, you can check the first link in the description. It's our M&F Mastery course, which gives you lifetime mentorship, lifetime signals, lifetime uh, access to our community. You get audiobooks about trading psychology, trading plan, and a lot more value from this course right there. So make sure you check the first link in the description and get started with us. All right, I hope you find value in this video. If you did, make sure you subscribe, like the video, comment in the comment section. Until next time, goodbye.